Hi, I'm William F. Bryant, and welcome to my Vopad podcast. Today I'm going to do a brief talk on the finance section, I think. And finance is blended with accounting, obviously. But they aren't actually the same thing, and they really shouldn't be treated the same way within your firm, business structure, corporation. The accountants typically, if you've ever seen the titles for the controllers, that's generally an accounting area. Accountants handle all of the compliance, legal, and it's not to say that they can't do cash flow and analysis, but and so there is some blending in there. But when you get into risk, strategy planning, and actual funding methods, that's finance. When you do your CFOs, a lot of companies always look for CPAs. But that's not really an essential requirement for the CFO. Yes, they do sign off on your statements, but the fact is that the CFO is there to back the vision and pursuant to strategy that the CEO develops by understanding all of the risks that are inherent in it and then finding funding to actually go ahead and do those strategies. Whereas accountants are more concerned with like cost control mechanisms within the firm. Once again, like I said, legal and compliance. When they actually do, I'm going to say bookkeeping, but it's not. It's more complex than that, because if you consider that when you use financial statements, if you've ever sat down to look at them, sometimes you see how they do additions on the quarterly. It's incremental increases. Some companies do this. Some companies will actually do more of an accrual method of payouts that would be, say, for example, executive bonuses. If you know that the executives are going to get a bonus at the end of the year, the accounts are going to accrue those over the cost of business quarter to quarter. And of course, they're going to determine how if it's relative to sales or something like that, if they're on track to get those. And so they're going to divvy it up. What that does is actually smooth out your statements. And if you didn't smooth them out, and if you didn't develop some kind of a method and some kind of an artistry to do that, then you would have these huge jumps in certain areas as you're looking at the financial statements. And that doesn't lend to an accurate reflection of what the company is doing, because the theory behind it is that as you do activities, you are building towards whatever these things are. For example, like the bonuses. As you are earning revenues, that you are building little by little to those, and so the accountants attempt to accurately reflect the actual state of all of the different accounts at that time period, whether they're just accruing little by little or whether they're all paid out at once, more of a discrete method, and how those are actually going to affect the books when you report them quarter to quarter. And so there is a difference between those two roles, and I think that this is a really important thing to start off with, because I've seen many times where companies will call, for example, they seem to blend everything, if it's bookkeeping, closing books, and doing that sort of stuff, into FP&A. And your financial planning and analysis is not closing in your books and doing a lot of that bookkeeping nature. The financial planning and analysis is looking at something like forecasted financial statements in order to assess where you're at as a firm with liquidity and your cash flows, because you need to know whatever strategy you're going to pursue, do you have the available liquidity and resources to pursue that strategy? And then you attempt to look at, especially in terms of growth, you attempt to look at first rough. You can get more detail as you go in, but you're looking at like relationships of what you need to build revenues, because if you're going to build revenues, you need support to build those revenues. For example, if you're going to increase the number of sales of an item, well, you have to produce more of it. So you need more machines, and you might need more workspace. You're going to need more workers. You might need more administrative staff. You might need more trucks for distribution. It depends on what you're doing. But all of those areas are going to be relative to your increase in sales. And then when you're actually doing your projections for your financial statements, you have to take other relationships into consideration and determine if they're actually a nice relative ratio proportion. Maybe you have steps, like for example, capacity for certain machinery. It might be up to, say it's 1,000 units, and then you have to determine if you want to get the next upgraded model or another one of the same model you have, and that in and of itself is another characteristic of strategic planning. But how much productivity do you need and how quickly do you need it? But maybe if that machine is at 1,000 units and you can do 1,000 units per year, just for just to gauge it somewhere, and you get another one that's the exact same model, another 1,000 units per year. Well, that's a step up. It's a step jump. And whether or not you're going to use all that, that's kind of another matter. But you are going to have to plan for potentially steps like that. It's not not all of your planned property and equipment and those fixed assets are going to move up nicely. You're going to have steps as you purchase capacity wise, and they're going to be able to process a certain amount of inventory to actually create products, and then it's going to take a certain number of people, so perhaps even your labor is going to do jumps. But you can get a decent relative estimation by just simply looking at your financial statements and determining rough ratios to what it is you're going to need to support additional operations. And that's more of your finance. You're hoping that the way the books are kept, and if you have a really good accounting staff and a really good controller with cost systems, you're going to be able to rely on those books to be able to make more accurate projections. And so that's where really your finance and accounting work together. But you don't always learn the exact same things, and you don't get as much immersion on each side. Like, for example, a lot of financial professionals, you can get certain, like your CMA, you're certified in managerial accounting, but that's going to go into a lot of operations and manufacturing capacity, because there are certain ways and certain things that you do a little bit differently in terms of cost analysis and activity-based costing and so on in your managerial accounting section. And of course, you do have to know how to do your principles of accounting and your bookkeeping, where it all comes from and what it actually means, and do all of your calculations. A lot of your corporate finance is obviously based on all of that kind of stuff. But when it comes to, for example, certain areas, M&A transactions, for example, yes, you're going to go into to do those, but there are certain allowable proportions of consideration for like a type A, type B, type C acquisition. And the more you get into it, the more familiar you're going to be with it. But accounts are going to have a much better grip on that, because they're going to be trained in, hey, how do we record this stuff? Another example is going into purchasing bonds or other securities. There are certain things that you have to do if you purchase them at a premium or a discount, and the usage of your amortization table, so you can do your interest expense and your interest gains properly. Where else are we for that? But anyway, your bookkeeping and the way, the method that you're going to do it is going to vary. And so that's where I'm talking about legal and compliance and the way you're recording things. And that's really where your accounts are supposed to be trained in those methods. And that's generally your controller. And like I said, typically your finance is going to be a little bit outside of that. That's also why I kind of divvy up my website the way I do because I do have an FP&A section. And then I kind of consider M&A like within that section, like a subsection of FP&A, because obviously a merger and acquisition is a strategic investment to, hopefully either increase synergies or increase market share and, get something back from your costs. But that's kind of a quick coverage I wanted to do on that. So from the other financial aspects that you're going to deal with in the finance section, and I just wanted to kind of cover a few of those. And I've been using the t-shirt company, okay, just to kind of keep things simple, because not everybody is going to have a lot of experience running a business, and so to use a more simple example can kind of help people picture this. And even people who work in huge firms and huge corporations don't always have a lot of the operational side understanding that goes with it. And so I think, using these examples are good. But I also think that there's a lot to be learned from an entrepreneurial position. And oftentimes small business owners aren't given enough credit for what they have to do. Now, maybe they don't know all of the different methods and theories that go into doing a lot of different analysis, and perhaps they could gain a lot more from it. I mean, that's what I hope, because that's what I'm trying to push. But you do learn an awful lot about a business, about total operations, and from there, I always believe that when you kind of get immersed in that directly into operations, and then you start kind of seeing what you can do with it, it means a lot more to you. And I think that's where the executive MBAs always came in useful, was because of the fact that they've already gone through a lot of the examples that you're talking about, a lot of the case studies that you're talking about. So it means more. I think you miss out on really what it is you're learning when you just jump right into it. And I know a lot of programs allow that now. But anyway, going back to the finance part. So the first thing that you have to do, small business side, you're going to have to find some way to gauge out how your company is performing. One of the biggest things about understanding finance for a company and understanding the way you're going to fund your company and the strategies that you're going to set out to do is you have to keep records. I mean, this is where the accounting and controlling comes into play. And that part has to be there, because you need to be able to set, hey, where am I? And then you set, your benchmarks. And if you've heard that term benchmarks can be changing. They don't always have to be the same thing. You can do them relative to an industry. You can do them relative to maybe what you've done historically. You can set up your own, but basically it's something that you can measure where you're at against. And that's a benchmark. And you're always hoping to use a benchmark that's kind of optimal. And that's what you strive for, and that's what you hope to maintain. And without having some way to record and see where you're at now, you're not really going to know where you're at, later. And that's why everybody uses the same kind of ratios and formulas, calculations, all those things. It just keeps everything, on a level that you can actually compare things and to make it simply. And so one of the first things you have to do is figure out how you're going to do your bookkeeping. Because I think when you are an entrepreneur and you're starting out small business-wise, I don't think it's a bad thing to learn how to do your books yourself. For one thing, usually your books, when you're first starting out, depending on what you're doing, aren't really so complex that you can't figure them out yourselves. I mean, you're not probably going to do investing in bonds and securities, so you're not going to have to worry about that. You're going to do standard for an industry. If you're making t-shirts, you are going to keep track of possibly inventory, materials, and maybe you are actually going to have machines, and you're going to perhaps have property and structures and insurance, and you're going to have to learn how to do your depreciations and so on. All of these things are not are not terribly complex to learn on yourself. You can do an awful lot of this just simply by taking the time to sit down and learn and study. Barron's and McGraw-Hill, a lot of your educational publishers, they make accounting books, and you can go through and they're going to give you wonderful examples, and they actually have your double entry accounting system so you can see what's going on, and they're going to show you exactly what you're doing. I also recommend that if you want to do it on a QuickBooks or something like that, I mean, of course, you can, and it is definitely easier when you do your reports. I think you'll find that when you have to customize things, certain things are easier in certain software systems than not. But I would also suggest, until you get so much activity going on that it's cost prohibitive, to actually keep your own accounting books. You can go into Staples or Office Max, and they have accounting journals and ledgers that you can set up and get used to doing your transfers of numbers between your journal and your account, so you can keep track of things, so you can kind of feel out, what are your debits, what are your credits, where do these come from, and why do we do these? And it actually begins to make an awful lot of sense once you kind of go into it and you see how it has to balance out. It kind of checks itself, and it's good just to see this, because as you go on and you want to figure out where you're going and how you're doing as a company, especially if you're going to do any kind of financial planning, you want to know, hey, where do these ratios come from and what do they mean? If you go through and you read any of my little papers that I did on my website under the financial analysis headings, you'll see them on the right tab there. You'll see kind of a building up from the statements first and some commentary on the statements, and then moving into some ratios and planning, and then some valuations. And so you can kind of see it build and what you need to know to get there. And it's tough to really understand what the ratios mean if you don't know where they come from. And I always figure, yeah, you're running a business, but you want to see your business as cash flows in, cash flows out, cash flows in, cash flows out, and keep track of how this is working. It's not just, hey, I'm paying this check for this. No, you're seeing this inventory come in, and you're already in your head like, I'm going to get this much product out of this much inventory. I'm going to hold it for this long, and this check is going to go here to hold for here. It's going to hold and provide insurance for it where I'm holding my inventory. Things like that. Like, you want to see the operations happen in your head so you know where your cash flows are going. And then you're going to get a much better and deeper understanding of your operations and what you can do to propel your operations. So when you start out to do your bookkeeping, it's always cash or accrual. That's what you choose, one or the other. Now, you can't flop back and forth. Most firms use accrual basis. Now, what this means is it's simply it's when you recognize revenue. In an accrual basis, you recognize revenue when it is earned, and there are guidelines to tell you per GAAP standards, like when you should recognize revenue. And then on a cash base, you recognize revenue basically when they give you that check. All right. And then I should say when a check clears. That should probably be more appropriate. Who knows if the check will clear, right? But those are the difference between those two things. So cash is kind of an immediate recognition when you receive or when you pay. And the accrual is, it's just that. Like, you're accruing until you receive it. If you're doing the accruals, you're obviously going to have an accounts receivable, and basically you're offering credit to your customers who are paying. Now, if you're running something where you're actually doing, say you're doing some kind of a electronic system that's offering payments, you are going to automatically have an accrual system. There is going to be, unless they're guaranteeing your payment, there is going to be a a lead time between when you're going to receive it, and obviously that gets smaller and smaller. Some they put it in immediately. I think some still might have a day or two layover, but most are pretty good about being immediate. And so you're going to kind of have to, weigh in how you want to do this. Accruals probably the best method to go with is, like I said, everybody uses an accrual system. If you're just starting out and perhaps you're doing, maybe you're doing a sale at the farmer's market, and you're only taking sales when you're there, and you're only taking cash when you sell, then you could probably use a cash basis. For pretty much everything else, you're going to use an accrual basis, because even if you're running a yoga studio and you're running classes, you might sell, multiple sessions. So you might sell 30 sessions for a certain amount. Well, you're going to need to do an accrual basis, because that's going to be unearned revenue until you've actually had the class, and then you earn that portion of the revenue, and then you earn the next portion for the next class, and so on. And, you go a little bit more into that when you go into your accounting books, but you're going to have unearned revenue. So accrual is the best method to definitely learn and probably use for your business. Like I said, unless you just do an on-cash basis in something like maybe a farmer's market scenario or something like that. So now once you have that going, so what else are you looking at with finance? Like I said, you help to build strategy, you do planning, and which, obviously involves funding, and then you have risk elements as well. Now, I'll talk a little bit more about risk in another segment, but just to know that every single choice that you have, something could happen that will affect whether or not that choice and that strategy turns out the way you think it does. Now, in a business world, you obviously measure that in cash flows, right? You're going to put cash out, you're projecting cash is coming in. That's your strategic decision right there. You're measuring that in cash. Anything that is going to possibly hinder that cash flow, deviate the amount that you're going to receive, or anything that's different from what you are projecting is a risk. When you do your risk assessments, you have to have kind of a broad understanding, and obviously people do this for a living as risk professionals, but you're attempting to determine risk on many levels. You have risk that maybe isn't going to be terribly financially draining and doesn't really happen that often, so that's less of a concern, right? You might have other ones that might be, lower monetary value, but a high probability of happening. Well, you might want to address that. And then, of course, it weighs all the way down to where you have the ones where it's perhaps a huge dollar amount where you would go bankrupt, but a very, very small probability. And so you have this huge range of risks. And these risks don't just have to be on strategic decisions in the future. These risks could also be just on actually receiving cash for the operations you've already done, or even sending out cash to purchase things like inventory. You have what are called control systems to make sure that anything that, like once again, that might hinder your expectations of the cash that you're going to get, the risk controls prevent that from happening. And risk controls, obviously for the finance folks, they kind of, for CFO, oversees it. And people will get training in cost control systems, but for accounting, that's part of your education. You do cost control systems. That's your area, controllers, hence the title, controllers. But anyway, you implement a number of different risk mitigation measures all over, and then you kind of assess the probability of them happening and how often they might happen, and then that's how you kind of rate where you're going to address it. You can't be so stringent as to prevent operations from happening when you do risk mitigation, because then, you're actually causing more harm than good, costing you more to implement the risk mitigation than actually what it's preventing. You can't have that either. You have to kind of make broad range considerations. But another perfect example for that, not just in control systems, but obviously insurance, right? There are many, many different types of insurance that go into play when you're running a business. And obviously the larger the firm, the more types of insurance really are available for your budget or even necessary for the firm, depending on if it's public or private. But yeah, so that's kind of like your risk area. Aside from the risk, we might as well just discuss cash management and optimizing cash flows. Like I said, funding, that's another area that you're going to be concerned with when you're doing your finance. You don't want to have wasteful expenditures, right? You want to be sure that you're getting the most out of every dollar that you're putting into some kind of investment. Like, for example, if you're purchasing any kind of asset, you want it to be as productive as you believe it can possibly be. And that's usually like capacity of output or something. If you believe that your machine that you bought is supposed to do 1,000 units a year and you're running at that capacity, then that's what it should be giving you. And if you're running below that, perhaps perhaps you're having too much for setup times or downtime for maintenance or other idle time issues. You want to know that ahead of time, because what you're spending out, you want to know what you're getting back from it. But that goes for all of your operations. And if you go into the way you set up your manufacturing lines or production lines, and you want all of those to be running as smoothly as possible, you want to be able to address your bottlenecks, which might be another area. Like for top level finance, they cover a lot of areas because everything in the business can be broken down in terms of cost. What kind of cost is going into it, and are we really seeing the benefit of that cost, right? And that's an entire firm, because in the end, that's what you're there to do. Is you're there to make a profit, to make money, and then that money is supposed to cover the costs. So really, that's what the whole thing, all operations in a business is running through your finance department, right? And so maximizing your cash flows is really essentially, that's where you get your return on assets, return on equities, asset turnovers, all of those different kinds of ratios that come in to measure out efficiency usage and kind of assess where you're at with the company and how your managerial staff, your manager decisions are actually doing. Really, when you're doing cash management also, it budget considerations, okay? I'm not a big fan of tightly controlled, centralized planning systems, which a lot of firms are. And most of the time, your budgeting systems are that way. Obviously, each area that would be in your firm fills out requirements, beliefs in requirements for what they're going to need for a given quarter or half year, depending on how you actually run your budgeting, and then requires cash flows to meet that budget. And so that's kind of how you plan what's going on, and everything works off of initially revenues, just like I said. But as a CFO overlooking and overseeing all of the different operations, as a CFO overseeing all of the operations, I tend to always believe there's too much. A lot of firms are too slow to react, and a lot of firms don't give their staff enough leeway to make their own decisions on things. And I think a lot of this is probably changing a little bit, but some people still like their corporate control. But it's slower. It's slower to make decisions. If you educate your staff to understand and see, like, bonuses are always drawn on this too, and that's another area for finance. But when you weigh things out, like, in a corporate controlled structure where everything is kind of like benchmarked against something. And I mean, you've probably seen this before. You incentivize people to kind of ask for more money on their budget than they really need. And then when they don't need it at the end, they try to spend all of it that they can just so they can justify having the same budget next year just in case they need it. If they know they need a certain amount of production to make their bonus, then they might finagle a way in which to report that they've made enough production to meet the bonus. There are all kinds of things that play out in this. My look at it, I actually always liked the point system that was done on filmmaking, because it was a back-end point system is basically a percentage on your net after all costs have been filled, that a lot of times the production doesn't often like to do this stuff, but that the star would make in lieu of maybe a higher salary in the beginning. So it's kind of like taking a risk, and so you're getting paid for that risk later on down the line. But maybe you got one point, and so you got 1% or maybe 2% or something on the back end. And I always kind of thought that was the best way to go about it, because when you have a rate like that, you've already covered all your costs, right? And so everything that's left over is just whatever you're deeming for profit. And you're also incentivized to get the most revenues, out there. I mean, whether it's, promoting it yourself or whatever you have to do, but you are incentivized to do it. And I believe that was the better way to do bonuses anyway. And so when I look at a system where you're actually looking at how you're top down looking at it and running operations and doing your budgeting and your cash management systems, I think it's better to do loose models to determine where you're at and how you're operating, so you have a measure against what you're running, but teaching your people what it is that goes into costs. And then when you actually have your margin at the end, wherever you're selling, you give like a ratted leveling from the base people up to your managerial staff on up to maybe your directors, and so they ratted, but it's based upon your margin on your margin after period costs. And so maybe you stockpile away maybe it's 0.1% or something. I mean, it really depends on what you're making. And then perhaps everybody in the line, they get 1% of that pool, and maybe the next level will get 3, and maybe the next level will get 5. But the whole company is actually pooling off of that. And so that just kind of comes out of there. And yes, it will affect a little bit of the return that you see on, equity or assets or whatever, and your ratios are going to be a little bit, but you're really just compiling based upon what you would be earning. And so it incentivizes everybody to be better, because if you explain to your people on the line how costs work, and every time they do a scrap, or they have to do a rework, or maybe they do it wrong and it's got to be reshipped, and you explain to them how all these costs are then incorporated into the cost of goods sold and how it eats away at your margin, and that eating away at the margin affects the percent that they're going to make at the end, all of a sudden you have people who are significantly more attentive. And that's a huge thing, because now all of a sudden you have people who, well, if my entire thing is based upon what we're pushing out, well, I want to incentivize marketing to go out there and be able to push and sell this stuff. I want to make sure the products are the best they can be, so marketing can do this. I want to do the best work I can, because if I do the best work I can, it actually lowers that cost, and it makes my bonus at the end that much bigger. If you do something like that, It's a better incentivization. And by allowing the people there at that level more control over what they're doing and not have such a rigid preconceived budget, and perhaps allow them to run costs the way they need it to be run, well, that is going to act as kind of a mitigating, risk mitigating control to prevent them from running costs out of, craziness. And also, if they do happen to have to go above, like I said, you can do loose planning on a budget, but it doesn't necessarily have to be tightly controlled. And if they do have to borrow money for something from the corporate entity, then, and this was a great point, you just have them borrow it from the corporate entity at whatever the cost of capital is. Maybe you can, if you want to break it down for that line segment, or you want to do it for the whole corporation, or whatever, however you want to do it, but you make them kind of lease it out from you that way. It's kind of as a loan, then that eats into their cost of capital too. So they might want to do stuff better. Of course, you don't want them to use old clunky stuff, but at the same time, old clunky stuff wouldn't allow them to produce as efficiently. So they've got a lot of stuff to weigh in there, but they're not going to make purchases unless they need to then, and so you don't want to make it prohibitive for them to do it, or you don't want it to be kind of like you want to give them the freedom to make those decisions. I hope I'm making sense on that respect. But that, I think that's a better way to do bonuses and really look at the way your line's running. It also, if you look at that, you can look at upper level management as not having as much to do or not having as much to control. But at the same time, you're going to need on-site, almost like consulting staff, and it was a really eye-opening reading through one of the CFO guidebooks to see how a very experienced and I think kind of innovative thinker approached the entire topic, which is where I'm discussing some of these areas from. But anyway, that's another thought and another consideration for the financial area, because you are going to have to dive into cash management, which incorporates budgets and a lot of the way operations are actually run within the firm. We can also dive into, marketing. I brought up marketing. Marketing needs a budget of some sort. You also need to evaluate more FP&A, because you might have product lines which are going to need obviously a marketing budget, and how you're going to break that down. They're going to do a lot of it, and they're going to come up with the budget, but you're going to have to oversee and kind of see if what they're coming up with the budget and payback times and all of those different ways to measure it. Outsourcing, that's another area that you would have to determine. The breakdown of what actually costs you to make a particular component or not. And I know a lot of people don't necessarily like the outsourcing concept, but outsourcing doesn't mean an entire huge part is done. It might be just one particular part that is cheaper for someone else to do because they're already set up to do the parts, and perhaps then it's cheaper. But there are a lot of things to take into consideration, and you're probably going to have to do that. I mean, your managerial levels will do it on their level as well. But if you're going to oversee the finances, then you're going to have kind of like that final say, like, yeah, this is a good deal. But when you're doing operations and you're making things, people oftentimes don't incorporate the fact that for a number of parts, you might need special machines. I don't know if you've ever heard the term injected molding or something of that. Like, you need special machines to do certain things, to make certain pieces, because certain pieces do need molds, and you might have to pour into them, whether that's metal or plastic or some amalgamation of some chemical. you need molds, but then these molds have to be held by, the line so they don't move and you don't have errors, and you might need a certain number of molds. And I mean, it's really fascinating what the engineers do on operation lines and how they get everything to work within certain specs and tolerance levels. Of course, that goes into Six Sigma stuff for operations within a certain tolerance level, and having 1 in a million parts be inadequate, and then having the other 999,999 be perfect. That's kind of your Six Sigma base. But you might not have the capability to do it. Somebody else might have the capability, and you really need this component. The chips are a perfect example that everybody is talking about and has been for some time. You don't have the capability if you're an automotive manufacturer to do your own chips. I mean, you could, but then you need certain machines and clean rooms and like anti-static rooms. The computer stuff and computer components is really intense, the amount of money that goes into having to create the lines, because you can't have any interference going into these little chips, and then you need special equipment to hold them and move them and ship them. And just like I was talking about, all of these different aspects that go along with producing a product that you probably don't have. And so that's why you outsource to somebody else, because they can do it and pump them out, and so they get the economies of scale. They might be able to do it for maybe few bucks a chip, whatever it is. And if you had to do it in order to get the money back for all of the building up of the operations and the new hiring and the machines, and you might have to start out paying $50 a chip. It might have to be 50 or 100 times more than what you could actually outsource it for. So those are considerations when you're doing some of the parts on your line. But you don't just always automatically jump to outsourcing. I mean, there are other things to take into consideration. When obviously oil costs go up, or container costs like they are right now go up, those are things that you have to put into consideration when you're actually doing your outsourcing. And there are a number of other topics. So I mean, deep dives into some of this stuff is necessary to get a real good judgment on what it costs and how it's going to affect the finances. But there then is another rub in the area of finance, because how deep do you go and how much time do you spend on each of these different reports and analysis? That's another issue all of itself, but also of consideration. So looking at all of this when you're doing your t-shirt company and considering these different areas, if you're a single person entrepreneur attempting this, you're going to have a little bit better understanding of your books. But now you know why you want to know how your books are, because you are going to have to determine how much cash you have coming in from operations, and figure out all these things. Is it cheaper for you to buy a machine and have somebody sew the t-shirts and clothing for you? Is it cheaper for you to outsource that aspect to somebody else and you just store them? Is it cheaper for you to have somebody else store them? You have to figure out where you're at and what your capacities are and how much costs are going to go to each thing. And we haven't really got even into the actual cash management and cycles that you have to deal with, which is a little bit more it's not complex. I mean, there's more calculations into it, but you have to consider other pieces of the overall operation, because cash flow in itself is kind of an operation unto itself. I mean, yeah, you've got all these products and inventory coming in, you make them and you're shipping them out to people, but the cash goes through its own little cycle, because yeah, you're selling to people, but they're probably taking it on credit. You give them accounts receivable. But if you've ever seen accounts receivable schedules, it's much the same as how they keep track of yours for an individual. You have 30, 60, 90 days schedule of receivables, which is why you might offer them terms to get a 2% discount if they pay, the net within 10 days. Otherwise, the rest is due in 30. So, I mean, that's where you see your 210 and 30 if you've invoices or payments, and maybe they don't. Maybe they pay it in 60 days, or maybe they pay it in 90 days. But the same token, perhaps you're ordering supply, and maybe they, for your shirts, they give you a certain number of type of shirt for your different size arrangements, and they do the same thing. They just put it on credit. You're good to pay it back, and so you do the same thing. But you also have other areas. I mean, prepaid expenses. Maybe you're paying rent for your facilities early, or perhaps you're allowing accrual of orders. I mean, you probably are, and you're taking those, and so those are all liabilities that you still owe. And so you've got all of these different things that are all claiming to money and hoping money comes in, and then money has to go back out, but they're all delays in time. And that's kind of what you're looking at for your working capital and what you need to have on hand, and then you assess the total amount of time it takes you to go through that, where you're kind of looking at your cash conversion cycle from the time you actually get your raw material inventory to the time you are selling it and receiving the cash. And so you're looking at these different metrics, so you can figure out how much you actually need on hand at all points in time, and maybe a little bit of a buffer. So that whole cash management system is all on its own. Almost sometimes it feels like it's almost separate from the operations that you're actually running when you begin to get into it, because you're just concerned about, hey, am I making the products? Are they getting to the suppliers? Am I making sales? Am I handling the returns? Are all of the operations running smoothly? And all of a sudden you find out, well, shoot, I don't have any liquidity. There's no cash in the account, but I have all these receivables. Well, yeah, the receivables haven't been coming in, so you can't really pay on credit. And it doesn't oftentimes work where you're like, well, yeah, but I've got all my books. Look at all these accounts receivable, to tell your supplier that, hey, I'm good for it. It's coming in. When you might have doubtful accounts. And, that's a little bit more on the accounting side of things. But you can see where the cash handling in and of itself would be a completely separate entity almost, and it feels that way, but it also is the lifeblood of your entire operations and what you're doing, which is why when you do the financial area and say you as an entrepreneur running the CFO aspect, you're really looking at the planning, the risks, the strategy, and the funding for how you're going to do these operations, because the funding might include the debt aspect. Maybe, and most of the time for growth, it does. You're not going to be able to fund dramatic growth, and you really don't want to do dramatic growth. It's better to, once again, figure out where you're at and what you can handle and where you're going, because you are probably going to take out some debt, some credit line, some credit card, something that you are going to be able to make use of to try to increase operations by purchasing more revenue, because you're going to need more revenue to have more. Purchasing more inventory because you're going to need more inventory to have more sales. You probably have to purchase more fixed assets, although there are ways to do that, because you actually have lease planning and options for a lot of fixed assets. And of course, then you have your operating leases and capital leases, and those have to do with, who gets to depreciate the item. If you're just operating, you're just doing expenses. If you're doing the capital lease, you get to depreciate. The person who owns it isn't doing the depreciation. But that's a little bit. Lease analysis goes into whether you plan on getting more benefit out of leasing versus buying. I tend to think that buying is oftentimes better, especially for key components in the operation, bottleneck areas, and so on, because of the fact that in hard times, I shouldn't say hard times, I should say that in an economic downturn, If you need funding capital, oftentimes you can still run a lien on your component if you own it. If you're just leasing it, depending on what your lease terms and agreements are and all that kind of stuff, you obviously can't. I mean, you may be able to renegotiate lease agreements and lease terms, and it also depends on if you're if whatever you're using is more of a high technology, because those things can change rapidly, and you may not be able to really make use of it competitively for a number of years. So those play into it as well. But I like the ability to lean on to get some cash flow if you need it during hard times. And so you really work out, hey, where do I lease? Where do I own? Where do I lease? Where do I own? Which is another component for your financial department. I think that loosely covers some of the areas of finance and accounting. And I know I really can't explain all of these in depth. And I'm not really, I'm just hoping to get you to get a very top level view on most of these topics and subjects. There's no way you can really know every single absolute bit about these. And no, I don't know if anybody expects you to right off the bat, and hence why you would hire, in my opinion, consultants, because they shouldn't be, once again, they shouldn't be consulting you on, what software to buy or how to use your software. They should be consulting you on how business operations work, and what you're looking at. I've never found a software that you couldn't figure out how to use if you understood what it was that the software was for. Like if it's for financial operations and you're using it to determine, cost of goods or activity-based costing systems for particular lines and the way you're going to divvy up your overhead. If you know what all that stuff is, then you can figure out the software. I mean, it's pretty easy. But if people are just teaching you what numbers to punch into the software, what are you really learning? I mean, there's a big difference between those two things. And so, anyway, I mean, maybe this one was a little bit long one, but that was a little bit about some of the finance areas and what you have to oversee, and a little bit about accounting as well. And I hope you got something out of it.